Beginner's Guide to Total Current Assets. Hey guys, today we're going to take a look at the Beginner's Guide to Total Current Assets. Let's get right into it. The Current Assets account is a balance sheet line item in the Assets section that accounts for all company-owned assets that can be converted to cash in less than a year. Current assets are assets whose value is recorded in the Current Assets account. Cash, cash equivalents, accounts receivable, stock inventory, marketable securities, prepaid liabilities, and other liquid assets are examples of current assets. Current assets are also known as current accounts. Companies that are publicly traded must follow generally accepted accounting principles and reporting procedures. Following these principles and practices, financial statements with specific line items that create transparency for interested parties must be generated. The balance sheet, which lists the company's assets, liabilities, and shareholders' equity, is one of these statements. Current assets is always the first account listed in the assets section of a company's balance sheet. It is made up of sub-accounts that comprise the current assets account. Many assets are considered current by various businesses across all industries. Most industries group their current assets into these sub-accounts, but you may also see cash and cash equivalents, marketable securities, accounts receivable, inventory, prepaid liabilities and expenses, or other short-term investments. First, there are cash and cash equivalents. Current assets are cash or can be quickly converted to cash by definition. Certificates of deposit, money market funds, short-term government bonds, and treasury bills are all examples of cash equivalents. These items must not have any restrictions that limit their short-term liquidity in order to qualify as current assets. There are also marketable securities. Marketable securities is the account that holds the total value of liquid investments that can be converted to cash quickly without reducing their market value. For example, if a company's shares trade in extremely low volumes, it may be impossible to convert them to cash without affecting their market value. Because these shares are not considered liquid, their value is not recorded in the current assets account. There are also the accounts receivable. Accounts receivable, the total amount owed to a company for goods or services delivered or used but not yet paid for by customers, is recorded in current assets if the accounts are expected to be paid within a year. If a company makes sales by giving its customers longer credit terms, some of its receivables may not be included in the current assets account. If a bill is never paid, it is recorded as a bad debt expense and is not included in the current assets account. It is also possible that some receivables will not be collected. This is reflected in the allowance for doubtful accounts, a sub-account whose value is deducted from the accounts receivable account. Finally, there is inventory. Inventory is included in the current assets account and represents raw materials, components, and finished products. However, different accounting methods can adjust inventory depending on the product and industry sector. It may not be as liquid as other qualified current assets. So, what exactly are current and non-current assets? If current assets are those that can be converted to cash in a year, non-current assets cannot be converted in a year. Some of the same asset accounts may be found on a balance sheet under current assets and non-current assets. This is due to the fact that those same assets may be held for a longer period of time, such as a marketable security that cannot be sold in a year or that would be sold for much less than their purchase price. Non-current assets include real estate, plants, buildings, facilities, equipment, and other liquid investments that can take a long time to sell. Non-current assets are also valued at the time of purchase because they are held for a longer period of time and depreciate. Current assets have no depreciation and are valued at fair market value. So, how do investors make use of their current assets? The total current assets figure is critical to company management when it comes to the day-to-day operations of a business. Management must have the necessary cash on hand as bills and loans come due. The total current assets figure's dollar value reflects the company's cash and liquidity position. It enables management to reallocate and liquidate assets as needed to keep the business running. Creditors and investors closely monitor the current assets account to determine whether a company is capable of meeting its obligations. Many employ a variety of liquidity ratios, which are a type of financial metric used to determine a debtor's ability to repay current debt obligations without raising additional funds. Meanwhile, financial ratios based on current assets exist. Each ratio compares the value of a company's current liabilities account to the value of various current assets sub-accounts. The current ratio assesses a company's ability to pay short-term obligations by comparing its total current assets to its current liabilities account, the value of debts due within 1 year. The quick ratio assesses a company's ability to meet its most liquid assets' short-term obligations. It divides the cash and cash equivalents account, marketable securities account, and accounts receivables account values by the current liabilities account value. Because inventory liquidity varies, it is excluded from this calculation. The cash ratio, which is calculated by dividing the value of the cash and cash equivalents account by the value of the current liabilities account, measures a company's ability to pay off all of its short-term liabilities immediately, using cash. The cash ratio is the most conservative because it only takes into account cash and cash equivalents. The current ratio is the most flexible and includes assets from the current assets account. These various measures evaluate the company's ability to pay off outstanding debts, cover liabilities, and cover expenses without liquidating fixed assets.